Thanks for clicking. The Bank of Canada has maintained its pause on interest rates, but it may have to delay that pause if global or domestic conditions delay the CPI from coming down in short order. This was the message coming from Deputy Bank of Canada Governor Carolyn Rogers at a speech at the Manitoba Chamber of Commerce on Thursday. The speech comes after the bank announced it would be holding on interest rates at its announcement on Wednesday, amid a growing number of concerns that higher rates in the U.S. would force the bank to reverse course on its pause and raise rates. And at the speech, Rogers addressed not only the bank's decision to maintain its pause, but also where the bank sees rates going forward. And she also discussed the bank's approach to U.S. policies pushing up Canada's inflation rate.
It's best not to think about it.
So what I want to do today is go over the Deputy Governor's speech where she outlines the sources of Canada's surging prices, take a look at where the bank sees Canada's CPI going forward, and then discuss some of the risks that the bank sees to its pause on the horizon. Canada's national real estate data is set to be released next week, and we're also waiting for Canada's inflation data for the month of February, set to be released the week after. We'll obviously have updates out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this speech. Very briefly, as we've discussed the bank's explanation for Canada's surging prices at great length on this channel before, Deputy Governor Rogers went over the global and domestic sources of inflation, noting that higher commodity prices, the war in Ukraine, supply chains, and increase in domestic demand were responsible for the skyrocketing inflation that we've seen in Canada over the past few years.
So these three global inflationary forces, a spike in commodity prices, a surge in demand for goods, and impaired supply chains, then ran headlong into another element, which was an overheating economy here at home in Canada.
And again, very briefly, blaming Canada's inflation rate on the Russian invasion of Ukraine isn't exactly genuine, considering our CPI was a 30-year high prior to the Russian invasion. With that said, an increase in commodity prices and broken supply chains were obviously major contributing factors to the increase in prices and largely outside of the control of the Bank of Canada.
Thank you.
Well, the bank is still on the hook for the increase in the money supply, transitory, and leaving interest rates at near 0% when our inflation rate was at 4.8. Regardless, Deputy Governor Rogers then went on to discuss the bank's decision to maintain its pause on Wednesday, noting a major slowdown in economic growth.
Growth in the fourth quarter of 2022 slowed a little more than expected, coming in flat.
Further, Rogers then stressed that although Canadians and the government are continuing to spend, housing and business investment are slowing down. And the slowdown in Canada's GDP, the slowdown in housing, and the slowdown in business investment, hopes the Bank of Canada, will lead to a slowdown in the labour market.
Weak economic growth for the next couple of quarters. We do expect the tightness in the labour market will ease, and as it does, pressure on wages should come down.
And this is the recession that the bank is hoping for that we've talked about so much on this channel. People who don't have jobs don't have bargaining power. They take what they can get. So the bank wants to see job loss so it can prevent a wage price spiral. And with all of that said, although the inflation rate is below 6% and although the Canadian economy is slowing down, Rogers stressed that the bank is on a conditional pause, meaning they could still raise rates.
It's a conditional pause, though. But if evidence accumulates suggesting that inflation may not decline in line with our forecast, we are prepared to do more.
So if Canada's CPI doesn't fall as fast as was outlined in the Monetary Policy Report, then the bank may have to raise rates. And given that that policy report is predicting the CPI to be at 3% by mid-2023, the bank has definitely left the door open for a further increase in the cost of borrowing in the next few announcements.
You have to move fast.
And Rogers also outlined some additional global risks to the bank's inflation outlook. With higher inflation in the US and in Europe, there is a risk that Canada could import that inflation.
The US and Europe near-term outlooks for growth and inflation are now somewhat higher than we expected in January. In particular, labour markets remain tight and core inflation is still high. Since these are our main trading partners, this could point to further inflationary pressure here in Canada.
Further, as we talked about before on this channel, China's reopening and the ongoing war in Ukraine could also push up energy prices, which would push up our inflation rate.
That a key risk to our projection, an increase in global energy prices, hasn't materialized so far, but China's economy is rebounding as expected now that it has reopened. The strength of China's recovery and the ongoing impact of Russia's war on Ukraine remain key sources of upside risk for commodity prices, including energy.
So, to summarize the speech, Rogers gave the usual explanations for Canada's surging inflation rate, reiterated that the Bank of Canada wants to see a decrease in demand and an increase in job loss, outlined some major global uncertainties going forward, and reiterated that the Bank of Canada will have to raise interest rates if it doesn't see the inflation rate return to 3% in short order.
Get it.
Indeed, later on, Rogers addressed higher rates in the US and how that is putting downward pressure on the Canadian dollar and upward pressure on inflation.
If our dollar depreciates, particularly against the currencies of our key trading partners, that means imports coming into the country are more expensive. That can put upward pressure on inflation. If that happens, that'll have to get built into our forecast.
And Rogers was asked to expand on this numerous times at the Q&A held following the speech. She was asked if rising rates in the US would have a negative impact on us here in Canada, and she didn't really answer the question.
Depending on what they're reacting to, it can have a different impact on the Canadian economy. If they're reacting to global inflationary pressures, it's very likely we're seeing those same global inflationary pressures in Canada. If their decisions are being driven by more domestic factors, that might not show up as much in Canada. As I said before, we run an independent monetary policy. We make monetary policy decisions in the interest of the Canadian economy. Certainly, as our major trading partner, the U.S. has an influence on our economy here. But the most important point I would make is our monetary policy is targeted for our economy.
She was then asked why the Fed was going higher than Canada.
Been spending like a drunken sailor all last week.
And again, she didn't really answer the question.
We are seeing inflationary pressures in Canada come down a little more than they're seeing in the U.S. There's also factors about the Canadian economy that are different than the U.S. economy. So again, I'd come back to the point I made earlier. You really need to look past just the decision that the Fed is making and understand really what's driving their decision. What are the things in their economy that are driving their decision, to really understand how that might affect the Canadian economy.
So when we look at Rogers' earlier comments, it does look like the Bank of Canada is well aware of the problems posed by a more hawkish Fed, a Fed that is raising interest rates, but isn't really ready to publicly address it or put too much emphasis on it.
Something very familiar about all.
When you look at the headlines following the speech, the majority of the headlines emphasize the bank's insistence that it's independent, that it can carve Canada's own independent path towards a 2% inflation rate. Yet, earlier on in the speech, Rogers stressed over and over and over again, be it from Ukraine, true or not, that U.S. inflation, European inflation, the U.S. dollar, the Canadian dollar, not to mention the return of China to the global economy, that there are a large number of forces which affect Canada's inflation rate, forces to which the Bank of Canada is going to have to react. And with all of these forces putting upward pressure on Canada's inflation rate, it's not clear that the bank is going to be able to maintain its pause over the next few months. With that said, we'll obviously have updates out on the Bank of Canada and its pause. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.